Hello everyone. So welcome to another video on the topic of bonds, that is long-term liabilities. And I have already made one introduction video where I have explained the previous, what is the bond and why the bond is issued, and then what are the transactions happen between the company and investor and etc. So all these videos will be available on a playlist by the title Bonds Long-Term Liabilities on my YouTube channel. So if you are seeing directly this video, so this is the second video, so please go to that playlist and start watching the videos sequentially from first to second, third, fourth, like that. So this is the second video. Earlier I have explained some introductory concept, and this is the problem that we are going to solve now. So anyway, since this is the first problem, just take a minute, look at the question and try to understand what this question is asking for, and try to answer this question. You can pause the video now and try to answer. Meanwhile, I will also solve the question and we can compare our answers. Okay, so let me work out this problem. Okay, on January 1, New Kirk company issued 300,000 8% 10 years bonds at face value. Okay, so this is an important thing, at face value, interest payable annually on January 1st. Okay, so prepare journal entries to record the following event: issuance of the bond. Okay, so let's do the journal entries for bonds. Okay, so New Kirk company journal entries for bond issue. Okay, so when was the bond issued? The bond issued on January 1st. They did not mention the year, so January 1st the bond is issued. Whenever you issue the bond, first thing is you will get the cash. Okay, so 300,000 and it is at face value. Okay, so you are getting a cash debit of 300,000. Debit, credit. Okay. So I'm making a journal entry. So this is account. Now what will be the credit side of this? So it will be bonds payable. So this is the bonds payable will be the long-term liability, and that will be credited by 300,000. Okay, so 300,000, 300,000 it is balanced. So this is the first one, that is the issuance of the bonds we have done. Next, accrual of interest on December 31st. Okay, so what happens on December 31st? So December 31st, the company accrues an interest expense. Okay, so what is the interest expense? Okay, so here if you see 8% interest on 300,000, this is for 10 years, but anyway 8% on 300,000. So let us calculate that. So what you do, 300,000 multiplied by 0.08, 24,000 is the interest. Okay, so that is 24,000 is the interest expense. That will be debited. Now what will be the credit entry? That will be interest payable. So next, what happens? That is this one, accrual of interest on December 13. Usually this is done as a closing entry or adjusting entry. Now payment of interest on January 1st. Okay, so now on January 1st of the next year, okay, so interest is paid. Okay, so interest payable will be debited by 24. So these two will cancel each other, so interest payable will be gone, and here 24,000 will be cash, credited from the cash. So your cash paid will be like this. In fact, these two pair of transactions keep repeating 8 times because 10 times, because this is a 10-year bond at a face value. Okay, so that's what was asked in the question, and simply we have completed this entries, and with this we have completely solved this particular question. Okay, so let's try one more question. Okay, so the one more question is something like this. Okay, so payable was. Okay, so again let me read the question here if it is not very clear. So Canyon Company issued 600,000 10-year 6% bond at 103. So what is the meaning of bond at 103? That means you are selling the bond at a premium, not at a discount. So you are selling the bond at a premium. Prepare the journal entry to record the sale of this bond on January 1, 2014. Now suppose the remaining premium on bond payable was 10,800 on December 31st of 2017. Okay, see, this is 2014. That means 15, 16, 17. 3 years is completed. Show the balance sheet presentation. Okay, so let us see what we can do in this problem. Okay, so again you want to try this, you can try, you can pause the video now and you can try answering this. But anyway, I will be doing it here. So for this you simply refer, if you go back, I have given a sample entry here. If you see in the first video of this playlist, I have explained issuing bond at premium. These are the journal entries. There will be cash, bonds payable and premium on bonds payable. Okay, so simple like that we can do. Okay, so Canyon Company journal entries. So now what is 103%? See, usually they say 103%, they will not say it. 96, 98, 103, like that they will say. So you have to understand it as a premium of 3%. Okay, so what is 600,000 into 103%? Okay, so let's do that. 600,000 into 1.03. Okay, so 618. Okay, so 18,000 is extra. Okay, so what I will do on Jan 1st 2014, my cash will increase by 618,000. Okay, so that is the first entry. Okay, so again if I refer to this, cash will increase by the total amount, whereas my bonds payable will only be 600,000 and premium on bonds payable so will be 18,000. So this credits and debits are balanced, and this is the journal entry for the this particular first transaction. Prepare the journal entry. Okay. So now the question is, suppose the remaining premium on bonds payable was 10,800 on December 31, 2017. Okay. See, what is the premium on bonds payable? It is 18,000. Okay. Now, what is the interest expense? So, by the way, this how many years is this bond? So this bond is 10 years. Okay. So 10 years, if I what you call divide this by okay, so I think here anyway this number is given. So premium on bonds payable was 10,800. So let's show the balance sheet. I think directly we can go to the balance sheet presentation. So this part is done. So this is the only the journal entry. So this statement is done here. So let's go to, I thought we have to calculate, but already this value is given. Okay. So now Canyon Company balance sheet partial. So I'm not giving the complete balance sheet, I'm giving the partial balance sheet. So important, what is the date on which the balance sheet is made? That is December 31st 2017. So in this case I'll go only for long term liabilities. So what are the long term liabilities? That is bonds payable. So the bonds payable will have the face value of 600,000. Next, what will be the this premium? Okay, so here we have to add. Okay, so if you see again, if I go back to this one, the sample balance sheet entry, bonds payable, this is discount, sorry, add premium on bonds payable, that will give me the carrying value. Okay, so here on this date it is known, it is given that 10,800 is the premium on bonds payable. So I have to just add premium on bonds payable, that is given 10,800. Okay, so therefore what is the carrying value? Okay, so our net payable or carrying value of bonds payable, so that will be 610,800. Okay, so this is how we have to show. Okay, so show the balance sheet presentation, that's what we have shown here, and this completes the answer. Okay, so I hope you are understanding this thing. So just you need to see how to what is asked in the question and how to present it. Okay, so this is what, it's all very simple if you understand the overall concept. Okay, so we have seen two problems here. The first problem is making journal entries for a face value bond issue, and the problem is making a journal entry for a premium and making the balance sheet presentation. Just one thing I want to show, although it is not asked in the question. See, they will, what is the journal entry for interest accrued on December 31st? Okay, so for example, if the question is what is journal entry on December 31st? So for the interest expense. Okay, so let us do that also, although it is not asked in the question. So let's do that. So December 31st is the date. Okay, on this date I will get some interest expense. Now what is this interest expense? We need to calculate later, but right now what is the regular interest payable? Okay. So if you see the sample this thing, it will have a interest expense and interest payable. Okay, so actually there will be one more debit entry anyway, so we can do the debit entry here, premium on interest. Okay, so first thing we can do, what we have done, see, we have paid we have received a premium of 18,000. Okay, so 6,000 is a bond and the premium is 18,000. So this 18,000 is over 10 years. Okay, so if I amortize, so 18,000 divided by 10 will give me 1,800 per year. Okay, so this premium on interest can be debited by 1800. Okay, so that we can do. Next, what is the actual interest payable? So what is the actual interest payable is 6%, right? 6% of 600,000. So 600,000 into 0.06. 36,000 is your interest. Okay, so your interest payable is 36,000. So from this 36,000 you remove 1,800. So that amount minus 1,800. Sorry. 36,000 minus 1,800. Okay, so I am getting 34,200. Okay, so this is the amount that is actually shown as an interest expense in your account books. Okay, so this is what is the debit credit entry of the interest in the journal. So this will repeat 10 times, because it's a 10-year this thing. So as it repeats 10 times, this 1,800 into 10 will become 18,000. So premium on interest. So this premium on premium on bonds payable. So gradually this 18,000 will keep on diminishing. At the end of the 10 years, the carrying value will become exactly 600,000. So at the end of 10 years, you pay off the 600,000 face value and you are done. Okay, so that is just the additional thing. Okay. So I hope you understood this concept. Let me show you the answer. I hope you understood this concept. So please practice this. Please go through this little at a slower pace. You will understand. And see you in the next video. If you like this video, please press the like button and subscribe to my channel and refer this to your friends. Thank you so much.